The Trump administration officially finalized an enormous $100 billion investment from the world's most important chipmaker, TSMC. Brokered by the U.S. Department of Commerce, this stands as the single largest foreign direct investment story in American history. When you add it to existing commitments, TSMC's total footprint in Arizona reaches a staggering $265 billion. That capital is funding 12 highly advanced semiconductor fabrication facilities on U.S. soil. But if you look at the global equity markets right now, you won't see a celebration of long-term American tech dominance. You'll see those exact same markets violently crashing. This split-screen chart illustrates the divergence. Over here, we have steady U.S. infrastructure investment. Over here, the stock market reality. NVIDIA fell 1.7%, which dragged down the S&P 500, while South Korea's Kospi index suffered a severe 6.4% plunge. Even the assets investors usually buy to protect themselves during a stock sell-off are taking damage. Gold took a massive $52 hit today, cratering to under $4,000 an ounce. To navigate this economy, we have to look closely at these two competing realities. We need to figure out exactly why global markets are panicking on the exact same day the United States mathematically secured the physical future of its tech supply chain. The companies actually making the chips are doing fine. TSMC just reported stellar second quarter earnings. The bleeding is coming almost entirely from the companies buying those chips. This bar chart displays corporate CapEx, or capital expenditure. It measures the cash companies invest in physical assets. Right now, tech giants are spending tens of billions of dollars every quarter to build out their AI hardware infrastructure. But look what happens when we overlay the realized AI profits on top of that massive spending. The line is flat. Investors are looking at this lightning, highly expensive gap between upfront hardware costs and actual software returns, and they are terrified. That specific valuation fear triggered severe profit-taking today. Memory chip makers got hit hard. Micron fell 4.1%, and SanDisk dropped more than 7.4%. This tech anxiety is highly contagious. The panic spread across the Pacific, hitting heavyweight Samsung and SK Hynix, which single-handedly dragged down the entire South Korean stock market. Massive infrastructure spending does not guarantee immediate economic miracles. The tech sector is watching early software promises collide with the very expensive physical reality of building out servers, making short-term investors highly vulnerable to a sudden panic. But to fully understand today's drop, we have to look past Silicon Valley entirely. This tech vulnerability is being dangerously compounded by a geopolitical squeeze in global shipping. Ongoing military conflict with Iran is putting intense physical friction and military pressure on crucial global choke points, specifically the Strait of Hormuz. Because transit through these waters is now so difficult, the September Brent crude oil contract is holding strong, creeping towards $79 a barrel. For Wall Street, expensive oil sets off a dangerous chain reaction. Rising crude prices push up broad energy costs across the board, which threatens to trigger a stubborn new wave of global inflation. When inflation rises, central banks have very few options. Investors know these institutions will be forced to keep interest rates higher for longer just to combat those rising prices. Those inflation fears just pushed the U.S. 10-year Treasury yield up to 4.58%. High yields create a toxic environment for non-yielding assets, which is the exact mathematical mechanism that caused gold to crash $52.70 today. Rising geopolitical energy costs act as a massive economic straitjacket. They simultaneously drain capital away from expensive AI tech stocks and crush traditional safe havens like gold. When you pull back from the immediate daily panic, the broader global market isn't permanently broken, it is violently transitioning. The previous phase of AI hype, fueled largely by cheap money and early software promises, is rapidly popping today. We are entering a brutal, capital-intensive environment. In this phase, physical resilience and secured supply chains matter vastly more than the underlying software code, which brings us back to the Arizona desert. TSMC's $265 billion megaproject and the massive localized footprint it requires is the ultimate proof of this new economic reality. Institutional capital is figuring out that building a true working foundation for artificial intelligence requires serious time, vital raw materials, and immense physical infrastructure. Traversing this transition will easily take a decade. And as we saw today, that process will be constantly hindered by geopolitical friction, expensive oil, and stubbornly high interest rates. Over the next 10 years, the true economic victors won't be the companies promising overnight software miracles. The winners will be the ones quietly and steadily manufacturing the physical future on secure American soil.